What a cool thought to know that you can spend your money and still replace it for your family. So one of the beautiful things about these whole life insurance policies is that we are in control. It's really a unilateral contract. So we pay our premium, and everything that's guaranteed within the contract, the company will provide. But we have control of how it gets paid, of when it gets paid. When you consider practicing infinite banking or putting your money into whole life insurance, it's important that you choose a proper company.
So the great thing is we have guaranteed growth, whether the company is profitable or not. Now, we only use companies that have been profitable for over a century.
But most of these policies, we will have the ability in older years to take future passive income. It may be what we commonly call retirement, but at some point, you can start drawing money to live on this.
These are the safest possible financial vehicles that you can own. You have guaranteed liquidity with your capital when it's in this vehicle. There's several ways that happens. You have guaranteed withdrawals. You have
Good afternoon, Hans, or on my side of the country anyway.
Yeah, what's up, man? Morning here in sunny Coronado.
Here we are on officially episode 3. Last week we talked about, or the last episode, we talked about some of the major myths surrounding whole life insurance, which is our vehicle of choice to practice the infinite banking concept. And today we're going to talk about why whole life insurance, rather than myths, is the perfect savings environment for our capital. And so we looked ahead and found that there's over 20 attributes of whole life insurance that make it a much more efficient place to put our money than a standard savings account or money market account or a CD or any of the other savings vehicles that exist. And so I wanted to start by saying that when you consider this, when you consider practicing infinite banking or putting your money into whole life insurance, it's important that you choose a proper company, because there's 2 types of companies. We use participating whole life insurance from a mutual company, the only thing anybody really should use for infinite banking. But there are also a lot of stock companies. Everybody's familiar with the big players in insurance that they've heard. I don't even want to name any companies on that, but a stock company, it has to protect their shareholders. So their first place that they want to share the profits with are the people that have bought stock in the company, much like somebody that's on the stock market exchange. Whereas a mutual company, each person that owns a whole life insurance policy with them or takes out a contract with them becomes a part owner of the company. So when that company makes profits, they're distributed among all of the owners. So you as an owner share in the profits of that company. And it's the best way that we can practice IBC with that type of company. So from there, we just wanted to highlight a lot of those attributes of whole life insurance and what makes it this perfect savings environment. And I'll start off first. These aren't necessarily in any particular order. We just spitballed on the past and went down a whole bunch of these. But the first thing we'll highlight is that they are guaranteed, unlike anything else. So it's a legal contract that you're signing when you take out a whole life insurance policy. We have guarantees in multiple places, but one of them is we're going to have a guaranteed death benefit. So when we walk off this earth, it's going to guaranteed pay to our family, our heirs, or whatever beneficiary we choose. On top of that, we also have guaranteed amounts of cash value. So we mentioned in episode 1, that's like the equity in your contract. And there's a guaranteed floor on that is actuarially calculated. It's going to go up with every premium payment. You're going to have more equity or cash surrender value in the policy, a guaranteed floor. Now, like I mentioned with a mutual company, because we share in the profits, it can only get better than that, but it does have a guaranteed increased floor. And finally, just like a mortgage, fixed rate mortgage anyway, we have a guaranteed premium payment. So if you think on an inflationary side, our premium payment, whatever, if a 25-year-old sets up a policy and has a certain premium payment, let's just say $1,000 a month annually, it doesn't matter, just for the sake of the example. When they're 75, it's still $1,000. And if anybody thinks about the time value of money, what happens with a currency, that's going to be relatively inexpensive at that point and still deliver a massive guaranteed death benefit.
Yeah, the next one we want to talk about, uninterrupted compound interest. Now, compound interest is often talked about in the financial world, but it's often misrepresented. Again, each of these bullet points is going to be a high-level overview, and each can and will be an episode unto themselves. So we won't get into too much detail. The way that compounding interest is used for future projections is a fallacy. When you're looking at guaranteed positive compounding interest with no negative years and no diminishing principal, the only place that you can get it for as a financial vehicle is participating whole life insurance. We have a consistent rate of return, and over time that rate of return grows as we factor in other aspects of policy growth, which we'll discuss in later episodes. But for the sake of today, having no negative years in your growth curve is the power of compound interest, and that's not how it's presented with other vehicles where they never account for what happens when your principal takes a hit.
Yeah, and if what Einstein Einstein said it's the eighth wonder of the world, compound interest. I guess uninterrupted would be like 8.5. So one of the beautiful things about these whole life contracts, these whole life insurance policies is that we are in control. It's really a unilateral contract. So we pay our premium and everything that's guaranteed within the contract, the company will provide. But we have control of how it gets paid, of when it gets paid, as long as it gets paid. We have control of what happens within the policy. We have control of accessing the cash on demand, which we'll talk about in a little bit. And it's not locked away. So if we choose to end that, we can end that without penalty, without fees. If we choose to keep going, if we choose to make decisions of what to do with things within the contract, it's all up to us. We are in total control of everything to do with this contract.
Next big point is liquidity. You have guaranteed liquidity with your capital when it's in this vehicle. There's several ways that happens. You have guaranteed withdrawals. You have dividends, which are non-guaranteed, but we'll cover more about dividends in future episodes. You also have guaranteed access to policy loans, which itself is going to be the next bullet point. So we'll get into more detail there. But the good thing with this is that the overall broader market lending environment is not applicable here. So as the Fed raises rates, liquidity dries up, banks tighten the purse strings and make lending harder. None of that matters here because you have a pool of accessible cash that you can access regardless of what the overall macroeconomic environment is. And if you think about the phrase keeping your powder dry, having that capital ready and available to deploy when there are opportunities in the market is invaluable. And that's not something we can show on a policy illustration, but that guaranteed liquidity is a huge attribute that doesn't translate directly into numbers or rate of return, but that power is invaluable. Think of it as the potential energy that you are able to access when the time is right.
Yeah. And I think to piggyback on that, Hans, is like a lot of people always focus on this stuff. If you get on the internet and everybody's worried about internal rate of return, what's the rate of return? What's the rate of return? But like you mentioned, what you can't show on that illustration is what I can't show is the external rate of return. So when I have access to a pool of capital to take advantage of purchases, to take advantage of investments, I'm going to create an external rate of return that cannot be calculated in comparison with anything else. An example of what you're talking about here in the liquidity, Hans, is I have a local friend who I've done some hard money lending to. He owns 60 something local properties, multiple millions of dollars in equity in his properties. Phenomenal investor. In May of 2024, I think it was last month when he called me, he couldn't get an $800,000 loan to purchase a portfolio off of another investor of 16 properties. And just because credit is tightening up and the nature of his work is that he's not a W-2 guy and the banks are giving this guy a hard time who cash flows tens of thousands of dollars a month. And they said, no, we don't have that problem whenever we have access to capital within our whole life policies. It's just, you can't put a price tag on that.
Keep your powder dry.
That's right. And where that rolls into is actually the flexible loan provision, which is really what gives us a lot of power in building wealth using the infinite banking concept. It's phenomenal. And I'm going through this right now. I'm purchasing a property right now. And the amount of documents I have to send to get the bank loan, because I don't want to put enough down to buy the whole property myself, but it's unbelievable. And as I take the cash value loan for the down payment for this house, there's no underwriting. I literally just filled out a form and sent it in and the money comes into my checking account. And just like that, it's guaranteed. The flexible loans, the loans from the company are guaranteed to be approved. And my repayment schedule, what makes it exceptionally powerful, is an unscheduled loan repayment. So they don't tell me how much to pay, when to pay it, how long the term of the loan is. As long as I pay it, or at least pay the interest, as everybody says, but then I'm good. However, to be true to Nelson's principles, we shouldn't be taking loans without having provisions to pay them back. But it's wonderful having that flexibility that if something happens, I'm not going to lose my car. I'm not going to lose my house. I'm not going to lose my rental property if I miss a month. And again, I can't put a price tag on that.
The next is dividends and interest. So the great thing is we have guaranteed growth whether the company is profitable or not. Now, we only use companies that have been profitable for over a century. That's where the dividends come in. As Brian mentioned earlier, because these are mutual companies, when the company has a profit, after they've factored in their costs of running a business, that profit is distributed among the policyholders. So we get those dividends annually based on our total contribution to the policy or to the growth of the company. So when the company is profitable, we get dividends. And even if they were to not be profitable, we have guaranteed growth. Now we'll get deeper into what is cash value and why simply the passage of time ensures cash value will grow guaranteed. We have two different ways in which our policy is growing. And in any market environment, no matter how the company does, we have contractual guaranteed growth. That gross interest rate varies by company. And then on top of that, while they are profitable, those dividends are distributed to policyholders. And we have what's called dividend options. But when your policy is signed and enforced, it's going to have a guaranteed growth rate no matter what the company does. But as the company is profitable and you receive these dividends, you have contractual control over what those dividends do for you. In the infinite banking world, we like to put them towards additional premium. And that's another way that we grow the policy and do several different things with them to help with the cash flow. We'll have a whole episode about dividend options in the future. But right now, as far as we're concerned with today, those dividends are another way that our policy grows.
Yeah, it's awesome. And the next point we want to discuss is that these things, depending on level of premium, everybody's would be different here, depending on level of premium pay, the amount of time it's paid, structure of the policy. But most of these policies, we will have the ability in older years to take future passive income. It may be what we commonly call retirement, but at some point you can start drawing money to live on this. And that money that we draw can be accessed tax-free, which is virtually impossible in any other vehicle that is used for passive income in the future. Just an awesome option that we have in the future, should we have the inability to earn whenever we're old. So that's a huge perk.
The next one we want to hit on is safety. These are the safest possible financial vehicles that you can own. If you understand the mechanics of a run on the bank and due to the fractional reserve banking system, there's no such thing as a run on an insurance company. And there's a few reasons for that. One is they are reserve backed. First of all, they are required to maintain 100% reserves for their current liabilities. Beyond that, they're required to have reinsurance for 100% of their overall portfolio of risk, which includes death benefits. So if they were to have higher than expected mortality, for instance, their entire block of insurance is 100% reinsured by another insurance company. And a final safety net below that is in order to sell their insurance product in any state, each state requires them to pay into a guarantee association, which is a backstop to where if their reinsurance wasn't able to handle the liability, the state would come in, this guarantee association would come in and make sure that all policyholders are made whole. And so to date, there's never been a whole life policyholder who's had their policy defaulted on because of these safety nets. So compared to any other financial vehicle that you can access, this is by far the safest, and this will be the last standing financial institution due to the regulatory nature and how much more stringently they're required to maintain capitalization compared to a bank or any other financial institution.
Pretty certain we'll talk a lot about the banks in the future episodes and why they're not safe. But yeah, awesome. So another great thing is the tax-free nature, or better, I should say, more appropriately tax-deferred nature of these policies. But depending on how we structure them, how we access the money, they can really be utilized in tax-free status. And the way we set these up is to protect that. It's a whole another episode that we'll talk about called the MEC line, modified endowment contracts. But when we structure these, we ensure that we have tax-free access and tax-free growth of the money. And yeah, it's going to be transferred in a death benefit to your beneficiaries in an income tax-free environment. It's going to grow tax-free, and we're going to have tax-free access, whether that be through the loan provisions, whether that be that future passive income that I mentioned before. But you can't beat the way these things perform when you consider that there's no taxes applied, and nothing else does it.
Yeah, and another thought on that, there's a book by a prolific life insurance agent named Ben Feldman, and a question that he asks is, what percentage of your state is not yours? So you think about what you've done across all these financial vehicles that you have. When you walk off this earth, the tax man is going to walk in. What percentage of that estate is not yours? And I guarantee you it's a fairly high percentage already. So by filtering money into these tax deferred vehicles where we can access it tax free, and then down the road, when you do walk off this earth, the entirety of your death benefit goes tax free to your family.
And even to couple with that is, it's a phenomenal book that Feldman wrote. But what is the tax implication of that in 40 years? And can you answer that? And are you thinking about how to mitigate that? Because I don't know what it's going to be. Do you?
No, definitely not.
Yeah, it'll definitely be higher. And I could calculate what it is today, but I can't calculate what it is. And I'd probably be wrong, but I could come close. But I can't even calculate what it's going to be in 2025, 2026, 2027. So this protection is super important, just so important.
Next thing we'll hit on is the lack of market volatility This is an uncorrelated asset. And so as the market does, it goes up and down, as it stresses people out, as they watch their balances decline, we don't have to deal with that. We don't have to worry about what the S&P 500 is doing, because our growth, going back to that guaranteed interest rate that we get, as well as the dividends, is uncorrelated with the market. There is an investment team at the insurance company whose job is to allocate their assets in the most efficient way, because they don't have a choice. They have to pay out more to a beneficiary than the policyholder paid in premium. That's a guarantee. They don't get to not pay that. And so they're very conservative in their investments, and they have a team of professionals that does not take the same risks that your typical money manager is going to take. They aren't speculative because of these contractual obligations. So we can watch the market decline and log in that same day and see that our cash value has increased. We remove ourselves from that fear of market volatility by being in this asset as our primary savings vehicle.
Yeah, the next point we have is that these policies are creditor protected fully in most states and partially in the others. And so what that means is that both the cash value and the death benefits of life insurance policies enjoy exemptions from creditors. They can't come after you. They can't sue you for it. They can't take that money should you default on other things. I don't know every single state and how fully creditor protected they are, but we will link to, it'll be in the show notes so you can look that up yourself and see where your state stands on that. But the majority of them are fully creditor protected, and there's nothing else out there. And let me tell you, if you have money in a savings account and something goes wrong, and you're getting sued, you're in a car accident, you're getting sued, guess what they're going to attach to? That money might not be yours if it's not protected properly. And so this will protect that cash value that we're building up and that access to capital.
Yeah, so there are implications while you're living. That's the liability protection that Brian hit on. And then there's the protection when you're dead. If you leave a wake of creditors when you pass, depending on your state, and again, that link will walk through what each state allows as far as creditor protection and liability protection. But you're protected while you're here and you're protected while you're gone. And the degree varies depending on what state the policy is in. But compared to any other asset, what other assets are shielded? There are some, but most are not shielded from a lawsuit while you're alive, and they're not shielded from creditors when you pass. So that's a huge value that it just comes inherent with this contract. So all the other powerful things we're talking about, this also serves as building that wall of protection.
One of the most common questions we get is what happens if we experience hyperinflation, or what happens in this current inflationary environment that we're in? And I don't know what the exact number is, but it's higher than what they report. And I would say that these policies are extremely inflation resistant. I think we still live in an environment that we're in, if not inflation proof. But one of the things that I talked about earlier in the call here was the fact that we have a guaranteed premium payment. So if I'll use the same thing. If I have a $12,000 a year premium and we hit a high inflationary environment, well, in 5 years, what does that $12,000 remain the same? So is that easier or harder for me to make?
That's going to be a lot easier in the future as we continue down this inflation track.
Yeah, absolutely. Another massive thing and a question that we always get is how inflation is going to affect these policies. Because when people are thinking about inflation, they're always thinking about rate of return. I got to beat inflation. But these policies are relatively inflation proof. And it's because it's an asset that's going to rise with the market. So the company, based on the portfolio they have, they are going to invest in things that captures the growth in the market based on an inflationary environment. We're going to have higher interest rates, and they're going to capture wealth based on those higher interest rates. Since we're in a mutual company, who shares in that increase? We do as policyholders in the form of dividends. So our dividends go up over time as our policy expands and grows because we've paid more premiums. So do our dividends. But as the company's creating more dividends, all of our shares increase. And this is on top of everything that's guaranteed already in the policy. And one of those guarantees, if you remember what I talked about in the beginning, was we're going to have a flat level premium no matter what. That cannot go up. It's contractual. So as the money inflates, or as there's an expansion of the money supply that creates the effects of inflation and things cost more and more, well, the price of our policy, the premium we pay, stays the same. So it gets easier and easier to pay that, while at the same time, it's growing more and more within. And we have access to the money through that flexible loan provision where we can start using those dollars in 2, 3, 4, 5 places. I can't really think of a better way to outpace inflation than using the same dollar multiple times. And finally, if you compare this to like rental real estate in an inflationary environment, what happens? The rents end up going up. The equity goes up because the value of that asset, that home, ends up going up. And it's really basically the same exact thing. And in that rental real estate, your mortgage, if you had a fixed rate mortgage, stayed the same. So you can increase your profits from that asset asset in an inflationary environment. Very similarly, nearly parallels what a whole life policy does.
All right, the next one we're going to talk about is these assets, the rights that you have to transfer. So you have contractual rights built into the policy. As Brian mentioned, it's a unilateral contract. As long as you pay your premium, that's your one obligation. You have rights that are codified, and some of those rights include ownership transfer, beneficiary change, what you're going to do with your dividend. And these are options that you have that can't be questioned. You don't have to run it by anyone or get approval. That's another piece of the control aspect of these policies that you lack in other vehicles.
Yeah, and not just the control, but the management. And these things are, our next point is very easy to manage. Just like you said, where you can transfer things around, managing the policy is easy. It's literally as simple as pay your premium. And then you have access to all of these other benefits that we're talking about. That is your high level of management. You don't have to think about, you don't have to log into your Fidelity account and think about what's doing good, what's doing bad, contact your asset manager, make sure he's making good trades. None of that exists. You literally pay your premium and have access to your capital. There's online portals. Some companies have apps, some don't, but all of this stuff for the most part can be done online or through an agent, and all these provisions in an easy to manage, just pay your premium. That's it. Pay your premium. That's the solution.
That next one, no fees or penalties. So we've hit it several times. Your premium is fixed and level for the duration of the contract. Built into your premium and your contract is the cost to the insurance company of running the company, maintaining their staff, cost of policy implementation, and then the actual cost of getting a policy in force and then growing it over time. And so you're not paying fees. You're not getting hit with annual fees. There's no maintenance cost. There's no cost for portfolio churn that you're going to find in a mutual fund. Your premium is your premium. And so when you sign that contract and you pay your premium, that's not going to change, and you're not going to be hit with increased costs or anything. You're not paying money to your agent when you set up this policy. You don't pay a fee to your agent to get this set up. The compensation is handled between agent and an insurance company without any impact on you as the policyholder. You get what you sign up for, and that doesn't change. If you compare that, for instance, to the assets under management fee that's common in the financial planning world, a 1% fee on your portfolio doesn't sound like much, but if you look at that projected growth that they're giving you, which by the way, they never show negative years, they show that positive uninterrupted compounding growth, which you can only get in a whole life policy, that'll eat up 40% of that projected growth just with a 1% fee. And so when we think of the cost to set this up, again, the premium is the premium, and it's not going to change. There's no early withdrawal fees. You don't have the same kind of regulations as you do around a qualified account, penalties, etc. This is simple. Your premium is your premium.
I just want to be careful there because we've studied that, but I want to be careful there and say that it can eat up to 40%. And because all that's going to be affected by how the market moves. But there's worst case scenarios where a 1% fee has destroyed 40% of the potential wealth without that fee. It could be less, it could be 30, it could be in the 20s, but it's going to depend how the market moves. And I just want to clarify that's not a hard math there, but it can happen, which is what we care about. It can happen, and it can't happen in whole life.
Right. And the way that it would not happen, the way that you would have a lesser percent, because that is all based on losing the ability of that 1% to grow for the remainder of that projection. Yeah, it might be less than 40%, but what that means is that projection is less in total value than it actually was. So it might be 20%. However, that's because the projection got nowhere near close. And so that 1% fee would be applied after those 40, 50 years of projected growth. So you'd have to know what that final number is, which you can't know. To know the impact, you'd have to know what the market does, which you won't know. So yes, it might be less than 40. It'll be around 35, 40% if the projections perform as illustrated, which they won't. And then that 1% fee, once that's factored in, it's going to reduce it. Now, 40% of 100% of the projection is probably going to be about the same as 20% of a lower percent of the projection, but that's getting into the weeds. But you will pay a fee that's much greater than it sounds.
Agreed. I just wanted to clear up that's not like a hard ratio or anything. Yeah, and this is something that's fascinating. I don't want to get in the weeds either, but it's people talk about, high commissions when it comes to whole life insurance. But when I hand you an illustration that has guaranteed, and if you only paid like a 100% base policy, which we haven't talked about policy design, I can tell you exactly what the floor is. And there's no other financial products I know of that can do that, because you don't know what that fee is now. You don't know how that fee is going to change in the future. nobody ever finds the internal fees in their 500-page prospectus. Nobody ever knows that stuff. And it's pretty wild that that's what gets hit hard, but there's no extra fees. This is what it's going to do at a minimum, and it can only be better. But what a cool concept. Anyway, yeah. And part of that is because these companies are reputable. The ones we would recommend using, the ones we do use for setting up infinite banking concept policies, the mutual companies we use, they have a minimum. And Nelson set this up as a guideline whenever he was teaching this, of 100 years or longer track record of performance and of paying dividends. So the companies we use, one, they've never defaulted on a death benefit. Massively important. Number two, they have paid dividends through everything. World War I, the Spanish flu, World War II, the Great Depression, the stock market crash in the 80s, the high inflationary environment of the 70s and early 80s. They paid it through 2001, through the Great Recession in 2008. They paid dividends all the way through the COVID madness. So you're in a place where these companies have been profitable through the worst economic times our country has seen and continued to expand.
Next is privacy. When you implement this system, your policies are not considered in the same basket that makes up your credit score. Or if you're going through the FAFSA application for student loans, which everyone entering college is going to have to do, this is not considered part of your total net worth. This is not considered part of your total credit score. When you take out a policy loan, it's not going to impact your credit score the same way that taking out other debt might. Also, going back to the liability piece, this is shielded from liability. That varies by state, as we mentioned. And again, that link will be in the show notes. But this isn't considered part of your overall net worth when a creditor or when you're being sued. So you have a degree of privacy that you don't have with other financial products.
Awesome. Our next point is waiver premium. We're going to do entire episodes on riders and plug away at this, but it offers something very unique. And beyond the fact that whole life insurance in general is something you have to qualify for, both medically and financially, which the fact that it's so exclusive, I think shows the importance of having it and why it should be considered. But beyond that, it offers other potential benefits. And this is called a waiver of premium for disability. And what this means is it's like insurance within the insurance. So if something happens, and simply put, you become too sick or disabled to work, the insurance company will pick up your premium and they'll continue paying it all the way to age 65. When they do, that means that at least on the min side, if we're not, again, depending on policy structure and depending on waiver, the rider structure, it's going to continue to pay that premium for potentially a very long time. And so it's the only self-completing savings plan that I know of with that extra insurance, because that money still credits and the cash value increases and the death benefit increases and all the other myriad of benefits that we've talked about can continue to happen even if you can't earn money in the way that you know how now or at all. Super cool. I don't know any other financial products that have something like that.
Yeah, and I just call that insurance on your insurance. IBC plugs a lot of holes in the dam, but if you can't pay that premium, like we said, and that's your one duty is to pay that premium in this unilateral contract. If you find yourself in a situation where you're disabled and you're 70% more likely to be disabled early than to die early, we're just plugging another hole in that dam. Next one I want to hit is asset protection. We're going to have a whole episode on human life value and what your greatest asset is. But in short, your ability to earn an income is your greatest asset. It's likely not any particular asset on your balance sheet. It's the fact that you can go to work every year and earn the salary that you're currently earning. You walk off this earth, you're going to be leaving your wife, your children, your beneficiary, many multiples of what you put into this policy. And we want to protect that asset of your earning capability. We don't want to just leave them the accumulated value of your other financial products, which then are filtered through taxes and probate, et cetera. We want a tax-free life value that you are worth to them to be guaranteed passed to them. When we talk about life insurance, people think of this is just leaving something to your spouse. It is. It could be better termed income protection. Again, if your ability to produce income is your greatest asset, then we are simply insuring your income to make sure that is there, whether you're there to earn it or not.
Most of these policies also come with something known as the accelerated death benefit rider. And a rider is just an attachment to the policy. You can think of it as riding on the back of the main policy. And this is very simply put, but it's just a phenomenal benefit. If you are diagnosed with a terminal illness and you can actually access that death benefit early. And there's a certain period of time, but you can access that money now. They'll give you a certain credit. There's a certain formula and give you a percentage of your death benefit prior to your death. So you can use that for whatever you want, actually. If you wanted to travel the world with it, you could. This is part of that unilateral contract. They provide the option to get this money, and you can use it for care, palliative care, home health care, whatever the case may be for you and your family, and the best way that money can be spent. But you can get that money before you actually die. Another cool perk. Another phenomenal side of whole life insurance is what we know as it acts as a volatility buffer in passive income years. So if you have money put into other market-based assets, such as a 401k with your company, for example, we know a lot of pilots, we know a lot of people in the airline industry. They're a good example because they get a 401k without having to contribute. So they're going to have those market assets, for example. And if those markets were to tank one year, such as 2008 or early 2020, rather than double dip against it, so now the market's down and you withdrawn money from your qualified plan or from your market asset, you can actually access cash value via the loan provision or via withdrawal to offset that loss and use that tax-free income to live on while the market is down. And what that does is it gives the market time to recover so you don't have a double loss. And there's some pretty good studies out there, which we can talk about much more in depth down the road, where if you had the opportunity to do 3 times any size loss in any 20-year period, you won't run out of money based on the 4% rule. And there are some occasions, such as if somebody retired in the year 2000, they were broke by 2012 if they only relied on their market asset on that 4% rule. So it's a cool thing. It really reduces the pressure on your other assets.
So that ties into our last bullet point here, which is, again, the permission to spend. In Proverbs 13:22 says, a good man leaves an inheritance to his children's children. Now, when you're in the distribution phase, aka retirement within the standard model, how comfortable are you switching from being this careful accumulator and building this nest egg into spending? Now, how do you know how much to withdraw? How do you know you don't know how long you're going to live? How do you know how much you can withdraw each year to support yourself and the life that you want to live in retirement, as well as leaving an inheritance to your children's children? That's not an easy task. So by having this backstop of insurance, we check that box. We guarantee that we're going to leave that inheritance when we walk off this earth, giving you that permission to spend those assets without the stress of, what if I spend them down to nothing? What if the market doesn't perform? But your estate's intact regardless what happens to those market exposed assets. And that's a huge weight off your shoulders and a weight off of those other assets when you know that you will be fulfilling Proverbs 13:22 regardless of what the market does. That's a comfort, and that is a position of strength and comfort and peace that you cannot get from any other financial asset.
And I might even say it's a duty. As a head of household for my wife and my children, it's a duty of mine to ensure that they are taken care of regardless of what happens. But what you're saying and what you're speaking to is a really common thing among people who, let's say they put all their money in a qualified plan. What often happens psychologically is they get to that point where they're in distribution phase, and then they act out of a place of scarcity and fear, because the same money they have to live on is the same money they have to leave with somebody else. And what you and I, like when we're talking to clients, often ask people is, if you had $1 million, I'll just use an easy, cool $1 million. If you had $1 million and I could guarantee you that when you die, it all gets replaced, would you be afraid to spend it? And everybody says no. But if you only have the one pile of million that you have to both live on and leave to your family, people become very afraid to spend it. And it's awesome. What a cool thought to know that you can spend your money and still replace it for your family.
Yeah, absolutely. It's incredible. And that's why we say this is the most powerful financial asset. And this is a broad overview of a lot of the features. Each of these can be its own episode and will be in the future. Come up with questions, jot those questions down. Anything we touched on today, we'll go into much greater detail in future episodes.
Yep. All right, man. Good stuff. Catch you on the next one.
Yeah, sounds good. We'll cover human life value and talk about what you're actually worth in the next episode.
So stop being a passenger in your family's financial future and boldly take control of your wealth.
We'll see you there.